Yes, hello everyone. Welcome to this brand new video on my channel. And I know this is one of the videos that a lot of you guys have been waiting for. Honestly, I can't even describe how many times I've had messages of people, popping up and saying, when are you going to bring out the fundamental video? When are you going to do it? And of course, a lot of the videos we've done on the channel so far have been all about smart money concepts, about technical analysis. But I feel like it's finally time to get onto fundamental analysis, especially because you guys know how much I value this and how much is a big part of my own strategy as well. So yeah, I'm going to be bringing a complete beginner's guide to all of this. Obviously, there's a lot to go through. So we're going to be going through some of the core concepts, and this is definitely somewhere you can start off with, a few key concepts that you're going to be learning, especially in the beginning. But then, of course, as you get more advanced, it's going to be more and more. And the thing is with fundamentals as well, honestly, learning never stops. Even at this stage that I am now, um, even got a whole course on it, and still to this day, more and more is being added to it. So yeah, guys, we're just gonna dive straight into it. And yeah, let me know down below. Obviously, like, comment, subscribe, and everything. Let me know if I should do more of these. But yeah, let's get straight into it. Right. So I've previously shown this in one of the other videos as a little snippet of a kind of an introduction to fundamentals as well. But this one we're going to be going a bit more in depth. Now, just before we get into everything today, I want to quickly bring across four key concepts that you need to know. Now, what I describe this as is an economic train. I can't remember exactly where I got this idea from on the economic train. Honestly, I think I was doing a lot of research once and something similar came up to this, and obviously just recreating it as well. Think of the economy exactly like this, a train. Now, what does a train need? Of course, you need coal. You need some coal to power it up. The driver, obviously, we're talking about some vintage type of trains here, not the modern ones. A driver, brakes, of course, to to brake, and then speed to keep on going. Now, these concepts all relate to four key words that we're going to describe this. So productivity, and underneath this, of course, we're going to get ideas like GDP. The central bank is exactly who drives this train, who's in control of all of this. Each country has their own central bank. For example, in the UK, we've got the Bank of England. In let's say Australia, we've got the Royal Bank of Australia, etc., etc. Then you've got the brakes. This is what I like to describe as the interest rates. So this is really what it's one of the tools that's used to either put a hold on the economy or even to speed it up a bit. And then in terms of speed, we've got inflation. Now, just researching these four things, productivity, central bank, inflation, and interest rates, honestly, you can learn so much. And this is pretty much the start of it all. Now, today, what we're going to be describing is monetary policies. With monetary policies, it's one of the tools that central banks use to pretty much control the economy. Its growth, its slowdown periods as well, everything like that. And one of the key ways is through interest rates. And we're going to be getting into all of that. So, monetary policies, there's two types. And if I really had to describe it, this really is the basics of fundamentals that you need to know in Forex. You've got contractionary monetary policies, and then you've got expansionary monetary policies. And these are pretty much the Google type of definitions that you're going to get. A contraction, let me just get my pen as well as I do this. So a contractionary policy increases interest rates. So interest rates go up and limits the outstanding money supply to slow growth and decrease inflation. So at this point, inflation is very high. Inflation at the top is very high. So the whole point of a contractionary monetary policy is because the inflation is so high, is to decrease that inflation. Then we continue, where the prices of goods and services in an economy rise and reduce the purchasing power of money. Now, this we can get into later on. But for now, we're going to pretty much focus on the relationship between inflation and interest rates. Then we look at the opposite. We've got expansionary monetary policies. So during times of slowdown or a recession, an expansionary policy grows economic activity. By lowering interest rates, saving becomes less attractive and consumer spending and borrowing increases. Now, I really want to put this in realistic terms. Contractionary policy. This is pretty much when you want to slow the economy down. Expansionary policy is when you want to, let's just say, expand it, or you pretty much want to expand it, grow quicker in a way. So let's just say expand for now. I'm going to give two scenarios of where we actually see this in the markets, and we're going to be getting into that in the live charts as well. A contractionary policy is exactly what we're seeing right now. Inflation is at an all-time high. So inflation, of course, for you guys that might not know and are really getting into the basics of fundamentals, search that up for sure. Definitely after this video, finish this video off completely, research inflation and really understand what it actually means. Now, when we have all-time high inflation, for example, as we do have in the UK at the moment, we're seeing cost of living increasing. Of course, in terms of the effect on the consumer, this is a negative. We can't be paying 10% more every single year on certain products. For example, on electricity bills, on petrol money, everything like that. So inflation, is going to have a very bad effect on the consumer and in general the whole population. And what we need to do is when we have hot inflation, when we have very high inflation, we need to cool that down. One of the ways is by increasing interest rates. Of course, there's different types of contractionary monetary policies, but one of them, or one of the main ones that we talk about, is how they control interest rates. And we're going to be getting into a few examples later on as well. Expansionary policies is when we really want to speed up the economy. That's when we're in a recession. So one example that we saw expansionary monetary policies is during COVID. If you remember the amount of benefits that people were getting across the globe, the effect that this has on the markets as well is very, very clear. And that's something we're going to get into right now. But pretty much these are the two basic terms that you really need to know: contractionary and expansionary. So here, interest rates increase. Here, they decrease. And pretty much it's a response to economic growth, particularly in expansionary policies. You really want to increase economic growth. You want people to get out there and, add value to the economy. But when it's contractionary, at that point, there's too much. So you really do need to slow down the economy. Hence why a lot of people suffer. And this eventually, too much contractionary policies leads into a recession. When we get the recession, we open up expansionary policies. This is something that I talk about in my course, pretty much market cycles. And it goes exactly like this. Pretty much like a wave. When you expand, eventually you're going to get a slowdown. You have to contract. You expand, you contract. You expand, you contract. This type of thing goes on and on and on. And that's exactly what we've been seeing pretty much throughout history as well. Okay, so let's do one example. Expansionary policy. So as we said, that's the basic definition we've got. But how does it actually look like? What we've got right here is pretty much DXY. So this is a representative of the US dollar. This point right here is 2020. Now, what was significant at that point? If you lot remember, of course, pretty much the whole pandemic in the world. 2020 is when we really were starting to hit, slow growth at the time. Obviously, businesses were shutting down. The whole world was shutting down. And what happens as soon as we start to open up? An expansionary policy, we want economic growth. So what happens? Interest rates decrease. And as that happens, what we tend to see is as we lower interest rates, the base currency becomes weaker. So in this case, the interest rate lowered. So for example, I can't remember exactly what the percentage was at the time, but we're getting close to, 0.25% towards the end of it, or 0.5%. I'm not too sure. But as that goes down, the US dollar depreciates as well. And that's exactly what we can see here. And if anything, the US dollar was one of the ones to have one of the most progressive, or one of the most aggressive expansionary policies. This was done through a few ways. One of the ways was lowering interest rates. One of them was through their bond buying system. But that is definitely for another video. Obviously, this is the real basics. I wanted to keep it as a complete beginner's guide, just to not confuse you guys any further. especially if you are coming from a field of smart money concepts. This type of idea is very new to you all. You must be thinking, okay, so during expansionary policies, how can we use this to our advantage? And it's exactly this. Not only is fundamentals going to help you in Forex, I'm not even joking, knowing fundamentals will help you in general in life. You know, you understand when is the right time to invest, when is the right time to be stacking up your money, what to do, what to put it in as well. You know, when we have a risk on situation, when we have a risk off situation, you really are going to understand the benefits of this all. And that's exactly what we started to see here. During expansionary policies, you know, things like stocks, things like crypto, they all go up in value because there's a risk on sentiment throughout the world. When we're in contractionary monetary policies, such as here, which we're going to be getting into now, you want to be doing the opposite. Now, when it comes to contractionary, what was this point? So if we look at the last slide, we ended off in July 2021. Now let's move to July 2021 over here. Okay. So it's at that exact point. In 2021, at that exact point, we started, well, the Fed started to involve themselves within a contractionary monetary policy. So what that meant, some of their bond purchases started to decrease. So that's something that we call tapering. That was talked about a lot last year, but in particular, so that went on, I would say, for about 6 months. Well, to be honest, even more than that. I would say up until this point. And then the overlap as well. We started to see interest. So this was tapering. This was all to do with the bond buying or the asset purchases decreasing. I'm going to talk about that some other time. But more recently and more, you know, the whole reason why we've been seeing US dollar so strong this year, and it's exactly what I've been saying all year to my students, honestly, in the Discord. In every fundamental breakdown, I talk about US dollar, Canadian dollar, two of the strongest currencies, and that's exactly what we've seen this year. Here, it was all about increasing interest rates, and that's exactly what we've been seeing. So, I want to question you guys. When we see expansionary, we start to see this. When we see contractionary, we start to see this. The base currency in a contractionary policies, interest rates increase, the base currency also increases. And so now you must be thinking, how can we actually use this to our advantage? Now, there's something called monetary policy divergence. And the best way to describe this is through USD and JPY. US dollar has been one of the ones to really keep contractionary. JPY has been one of them to keep expansionary, or some other keywords that you may really pair up with this as well. If you are contractionary, you are hawkish because the central bank is increasing interest rates. You are dovish if you keep interest rates as low as possible. So you're either reducing it or keeping it as low as possible. These are the two terms that you're going to hear a lot of when you do your fundamental research. Now, with USD JPY, US dollar, what were they doing? They were increasing interest rates. So therefore, US dollar buys up. And this is talking about the real basics. There's so much we can get into. And you're not only going to see US dollar get stronger just because they're increasing interest rates. It's about everything else as well. But I really want to break it down to the beginner guide. Then JPY has kept it as low as possible. And to tell you as well, they've kept it in negative territory. So whereas right now, for example, with US dollar, we might be at 3.5% or wherever it is, US dollar JPY, we're at minus 2.5%. So if you've got a stronger US dollar and you've got a weaker JPY, what that means is USD, JPY, oh, I haven't even spelled it right, but you know what I mean, buys up completely and with force as well. Since the start of 2022, just look at this chart. Honestly, when I first was talking about this with my students, it genuinely looks like a crypto chart. Something like what was that? what was that crypto Shiba. Exactly like that. You know, when you're seeing this kind of thing happening in the market, there has to be a reason. And knowing fundamentals at the time, you know, if you understand all of this, you're never going to want to sell USD JPY. You're just going to want to be buying. So you're only looking for buy scenarios. And this is exactly how you use fundamentals. You really want to look for the pairs that have a clear bias. And this is exactly what I do, particularly when it comes to my group as well and my whole course. Obviously, we get into a lot of detail in the fundamentals course. Obviously, this is a service that I provide, and you know, we really do get into detail. About 80 videos, 40 going through technicals, about 40 going into fundamentals. So even just the first section, really going into the basics of everything, and then moving on later on, for example, pretty much everything else, you know, quantitative easing, for example, and everything like that. And then obviously at the end, how to actually apply it all to technicals. And this is exactly, I'm going to give you a little insight into how to do that. If you guys are interested as well, the Discord group that comes with it is lifetime access. Obviously, it's all one-time payment. But yeah, a lot of my students, you know, they come from a smart money concept background, but they don't really understand fundamentals to a very high degree. And that's pretty much what most of the guys sign up for, really. You know, it's getting that fundamental backing in the market, really understanding where is the direction we're going to go in before the week even starts. You know, that's the type of thing that you'll be able to sort of work out. Now, getting back into the video. Okay, so how to use this on a weekly basis. I'm just going to be giving an example, and I'm writing an ebook at the moment that I'm going to be sending out for free to everyone. This is pretty much how I go about my weekly analysis, you know, in 5 simple steps and really breaking it down in detail. For example, a recent one, GBP USD that we were looking at. US dollar fundamentals were showing us clear signs for buys at the time. The pound, you know, obviously we had a mix of some positive signs and then more negative, but definitely we could see that the negative, you know, outweighed the positives. And of course, you draw your conclusions from all of that. The main reason for this, pretty much US dollar has been one of the most progressive in terms of contractionary policies. So they've been very aggressive in their rate hikes and everything like that. When it comes to the pound, you know, so many negative signs. If I really got into it, then I would be here forever. But essentially, you get to the point where you understand GBP USD, I'm only going to be looking for sells. So using this bias, I then get into the market. And then, I'm sorry about the quality of this because obviously it's a screenshot, but I get into the market only looking for sells. And when I'm looking at the ebook at the moment, I'll just quickly show you the example of GBP USD that we were looking at. Exactly this. Breaking it down to a point where even before the analysis starts, and this GU analysis was sent into the group before as well. Obviously, we do have the weekly calls and everything like that, where we go into detail, first of all, fundamentals, and then second of all, obviously, all the technical analysis. This was pretty much the analysis we were waiting on. So for these cells just above these equal highs, and as you can see, price completely mitigated that and then onto the downside, and it continued further. So this is the type of thing that fundamentals will help you to do. And what we've really looked at today was the very basics, just 2 key concepts: contractionary monetary policies, expansionary monetary policies. As simple as that. I don't want to go any more into detail with all of this. Obviously, we're going to be looking into it at a later stage. But yeah, guys, if you really want to learn in detail and be serious about all of this, obviously the course, link in the description, everything like that. Definitely check out my Instagram as well. A lot of value is posted there. And then from time to time, you know, we just recently hit 25K followers. So I'm going to be following it up with, you know, a limited time discount that I'm going to be introducing. But yeah, definitely follow me up on Instagram. I'm always active on there. And yeah, guys, that's pretty much it for this video. Hope you all benefited. And yeah, take care. See you all in the next one.